Thanks for clicking! Canada's fixed mortgage rates are surging higher. This despite it looking more and more likely like the Bank of Canada is going to engage in a jumbo rate cut come Wednesday.
They both can't be true.
Indeed, while we did see some sub 4% mortgage rates in September, as the Federal Reserve in the United States was cutting rates, mortgage rates in Canada have popped back up again, following rising bond yields, proving once again that despite what your local expert tells you, just because the Bank of Canada cuts rates does not mean that fixed rate borrowing costs go lower.
Yes, it does.
So what I want to do today is go over my best fixed mortgage rates for the month of October, take a look at what could be pushing interest rates back up, and then discuss some implications. The Bank of Canada is set to make its interest rate announcement on Wednesday, along with a press conference held thereafter, and we'll obviously have an update out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these mortgage rates. On to the mortgage rates. First up, my best 5-year fixed insured mortgage rate. An insured mortgage rate, if you'll remember, that's where you have less than 20% down, you have a 25-year amortization, you qualify at the contract rate plus 2% or 5.25%, whichever is highest, and of course you pay the mortgage insurance. My best 5-year fixed insured mortgage rate in August was 4.59. That plunged in September down to 3.99. It is now up to 4.19 in October, with a 5-year variable rate mortgage sitting at prime minus 1.1 or 5.35%. So, following Canada's bond yields, we saw a massive plunge in fixed rates in late September, but now that yields are back up, moving higher, mortgage rates are following them as well.
It can't be stopped.
Next up, my best 5-year fixed insurable mortgage rates. Insurable rates, that's where you have that 20% down. You still have a 25-year amortization. You qualify at the contract rate plus 2 or 5.25%, whichever is highest, and you do not pay that mortgage insurance. My best 5-year fixed insurable rate in August was 4.69. That dropped down to 4.49 in September, and then has jumped back up to 4.64 as of this video, with a decent 5-year variable rate mortgage sitting at prime minus 0.8 or 5.65%. So again, insurable rates higher than they were in September, despite all of the talk of major jumbo rate cuts coming from the Bank of Canada. And finally, my best 5-year fixed uninsurable rate. An uninsurable rate, that's where you have that 20% down, you take money out of your home vis-a-vis an equity takeout or refinance, and or you have a 30-year amortization. You qualify at that 5.25 or 2 points above the contract rate, whichever is greater, and of course you do not pay the mortgage insurance. My best 5-year fixed uninsurable rate in August was 5.04. That dropped down to 4.84 in September, and actually that did drop down to 4.74, with a 5-year variable rate sitting at prime minus 0.6 or 5.85%. So, insured and insurable mortgage rates up about 15-20 basis points in October, despite inflation coming in at 1.6, and despite mounting evidence that the Bank of Canada is going to be cutting rates and drastically.
It's not possible.
And the reason for this disconnect, falling interest rates coming from the central bank but surging fixed mortgage rates, is, as it always is, coming from the United States, as its hot jobs data has sent yields surging. Robert Kapchik of the Bank of Montreal recently noted that with hotter than expected economic data coming out of the United States, expectations of further cuts have been dialed back, which will spill into the Canadian bond market, which aligns itself with the United States. So, with the recent report showing that inflation had ticked up in the US, combined with the hot jobs report, markets are now cutting back their expectations that the Federal Reserve is going to be cutting and cutting drastically. And while some are looking at this data and trumpeting the strength of the US economy, I think it's worth noting that the US deficit just came in at $1.8 trillion. The third largest on record. The deficit, remember, is different than the debt. The deficit is the difference between what the US spends and how much it brings in vis-a-vis taxes. So, the US is spending $1.8 trillion more than it's actually bringing in, which is stimulative. But to put how stimulative into context, let's take a look at the past 4 times that the US has borrowed that much money relative to its GDP. We have, right now, obviously, COVID, the aftermath of the global financial crisis, and World War II. All emergency level spending, except for right now, as there's no emergency occurring. Besides maybe the debt. But so what? The US is borrowing a whole ton of money, much more than it's bringing in. Why would that affect bond yields? The problem comes in that deficit spending, being stimulative, is also inflationary, with the IMF warning just a few months ago that US deficit spending would continue to push up prices. And before moving on to the bond vigilantes, let's remember that this probably isn't going to be getting any better anytime soon, with predictions coming in that, regardless of who wins the US election, deficit spending is likely to grow and grow substantially. And this deficit spending, this $1.8 trillion, has reignited a discussion of the bond vigilantes, those big, long-term investors which can and do sell government debt when governments act irresponsibly, sending yields higher. These holders of government bonds, these holders of U.S. debt, are particularly concerned with inflation, as when inflation goes up, that erodes the value of those bonds. That erodes the real return that investors can expect on their bonds when they come to maturity. And if investors think that the U.S. is spending in a manner in which they deem to be inflationary, then they're not going to want to hold their current bonds at their current yields. They're going to sell those bonds, and as we've discussed so many times on this channel, when bond prices fall, their yields go up. And when the yields on U.S. Treasuries move up, so too do the yields on Canadian bonds. And given that you and I are deemed for now to be less safe borrowers than the Canadian government, that means that you and I pay higher mortgage rates as well.
Dear Mr. President.
So, putting this all together, the United States is spending $1.8 trillion more per year than it brings in. It's borrowing that $1.8 trillion per year, putting it into the economy, which is both stimulative and inflationary. We are seeing at least some of the partial results of that stimulative policy with the hotter than expected jobs report and inflation ticking up. And we're seeing the return, potentially, of bond vigilantes, selling U.S. Treasuries, which are pushing up U.S. yields, pushing up Canadian yields, and therefore pushing up Canadian mortgage rates. Notice throughout that entire discussion explaining these surging mortgage rates, not one mention of Bank of Canada Governor Tiff Macklem.
I'm a little baffled, but yeah.
Now, how much deficit spending, how much inflation these bond vigilantes, these vigilantes that took down the government of Liz Truss in 2022 are willing to take, that remains to be seen. But yields are rising, and it looks more and more like U.S. deficit spending is going to continue to grow, along with the inflationary pressures that come with it. So, in summary, while many thought that Canadian mortgage rates were going to continue their downward path in perpetuity, it appears as though that is not the case. As we've discussed so many times on this channel over the past few years, what comes out of the Bank of Canada is, despite popular opinion, of relatively minimal importance compared to what comes out of the United States. We're seeing that come to fruition right now with surging mortgage rates, despite a near consensus that the Bank of Canada is going to be cutting rates and cutting them fast. So, as always, it's not as simple as the Bank of Canada decides to cut rates and we're heading to zero tomorrow. There is a lot more complexity involved in global monetary policy. We will obviously continue to track events coming out of the United States and how those events affect us here in Canada and our own borrowing costs on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.